If you have ever caught yourself staring at an old pension statement, wondering if you actually qualify for that monthly check, you are far from alone. Millions of workers approach retirement assuming their pension will simply trigger automatically once they turn 65, only to face a maze of eligibility rules, vesting schedules, and service requirements that can drastically alter what they receive, or whether they get anything at all. Understanding whether you qualify for a pension, when you can start drawing benefits, and how much you will actually receive comes down to a few critical rules that govern how pension systems operate. The single most fundamental threshold in any traditional pension system is vesting. Before you can collect a single dime from an employer-funded pension plan, you must be vested. Vesting simply means you have earned the non-forfeitable right to your pension benefit. If you leave a company before reaching its vesting threshold, you forfeit the employer-contributed portion of that pension, regardless of how hard you worked or how long you were there. Most traditional defined benefit pensions use one of two primary vesting schedules, cliff vesting or graded vesting. Under cliff vesting, you receive 0% rights to your employer's contributions until you hit a specific milestone, most commonly 5 years of continuous service. Once you hit that 5-year mark, you are instantly 100% vested. Under graded vesting, your rights build incrementally over time, often starting at 20% after 2 years of service and increasing by 20% each year until you reach full vesting at 6 years. A common fear among near retirees who worked for multiple employers throughout their careers is that they lost track of pensions from previous jobs. If you worked for an employer for 5, 7, or 10 years back in the 1980s or 1990s and then changed companies, that pension benefit did not simply vanish. As long as you met the vesting criteria at the time you left, that benefit belongs to you. However, pension administrators do not always have your updated address, email, or phone number. If you suspect you have a vested pension from a past employer, you need to check your old plan summaries, contact your former HR department, or use official database registries like the Pension Benefit Guarantee Corporation's Unclaimed Pension Search. Beyond vesting, the next critical element of pension eligibility is the relationship between your age and your years of service. Unlike personal retirement accounts where you can withdraw funds at 59.5, pension plans operate under strict age and service benchmarks that dictate when you can begin collecting payments without penalty. Most plans define a normal retirement age, which is usually 65. Reaching your normal retirement age with the minimum required years of vested service guarantees that you will receive 100% of your calculated monthly benefit. However, many plans also offer early retirement options, often beginning as early as age 55, provided you meet a minimum service requirement, such as 10 or 15 years. The crucial detail to understand about early retirement is the early retirement reduction factor. If you choose to take your pension prior to reaching normal retirement age, your monthly check will be permanently reduced. This reduction accounts for the fact that the pension fund expects to pay you for a longer span of years. A typical reduction might be around 5% for every year you claim early. Taking a pension at age 60 instead of age 65 could permanently shrink your monthly payout by 25%. Many public sector pensions and union plans utilize what is known as the Rule of 80 or Rule of 90 to evaluate full retirement eligibility. Under these formulas, your age and your credited years of service are added together. Once the combined total hits the magic number, you qualify for unreduced, full pension benefits regardless of whether you have reached traditional retirement age. For instance, under a Rule of 80 system, a 58-year-old worker with 22 years of continuous service adds up to 80, allowing them to retire with full pension rights immediately. If you worked part-time, federal standards under laws like ERISA generally dictate that employees working at least 1,000 hours in a 12-month period, roughly 20 hours per week, must be granted credit for a year of service toward pension vesting. If you spent years working part-time for an organization, you may be eligible for benefits even if you were never classified as a full-time employee. Your final average earnings are calculated by taking the average of your highest earning consecutive years, typically the highest 3 or 5 years of your career with that employer. Knowing this formula allows you to make informed decisions about the timing of your retirement. Working just 1 or 2 extra years late in your career not only adds to your total years of service in the formula, but if you received recent raises, it also raises your final average earnings baseline, compounding the size of your monthly check. When you prepare to claim your pension, you will also face a critical election regarding survivor benefits. A single life payout gives you the maximum possible monthly check for the rest of your life, but payments cease completely upon your death. A joint and survivor option reduces your monthly check slightly during your lifetime, but guarantees that your spouse or designated beneficiary will continue to receive 50, 75, or 100% of that monthly income for as long as they live. For married individuals, federal law usually requires written spousal consent if you elect anything other than a joint and survivor benefit. To ensure you receive everything you have earned, take immediate action to verify your status. Request a formal benefit statement and a summary plan description directly from your pension plan administrator. Carefully review your recorded years of service to ensure every month of employment was accurately credited. If you discover discrepancies between your work history and the administrator's records, gather old W-2 forms, pay stubs, or tax returns to file an official service audit before you officially submit your retirement paperwork.